does this change everything, or our portfolio is going to continue rising the way they nicely have done for the last few years? So welcome to this. You'll want to grab a pen and paper. We've got a heck of a lot of information as ever to get through. I'm going to share my screen with you on here. Here we go. Right, you should see a picture of the Don right there. Let me know you can hear me and see me as well. Hi, Kavita. Welcome. Welcome, everybody else. Sorry it was a short notice webinar, but it's incredibly important what we have to go through. So as ever, it's not individual financial advice. It's for information, education purposes only. This is what the past weeks look like. Now, if you think the past week is indicative of the changes that we're seeing in the market, and I'll come to that later. But if you think the past week's noise is some indication that things might have changed, then you would be somebody who's in the camp of, well, we better get out of the big tech companies, maybe go into a few of the selected semiconductors like AMD, Micron, both of which I hold, Intel, bit too, well, it doesn't tick all our boxes in the case of Intel. And you might think, well, energy is still going to be needed, and consumer defensives you're hearing a lot of, and you can see it there, Walmart, Costco, PG. But there's a problem with that hypothesis. First of all, it's based on very little data the past week. As Trump's Davos speech has just shown, the problem with what he's just said is, well, he could flip and flop, change his mind. And in fact, has he said anything new? Is it different? Should we be all rushing into utilities or energy? And are we then not trading and chasing noise? Is it not better, therefore, to have companies which are going to be resilient to these falls? You might say, well, wait a minute, what's resilient? Apple, Amazon, this is the past week alone. Microsoft, Nvidia don't seem to be. Well, no, resilient doesn't mean never falling. It means that they will have some falls, but we don't need to panic because their balance sheet, cash flow, and P&L are solid. So we're going to follow through with some of this theme. The mistake people are going to make is they're going to listen to Trump, they're going to panic, and they're going to start sector rotating and chasing themes like consumer defensives, as opposed to, and there's nothing wrong with a consumer defensive like Walmart or Costco, other than have you checked it against value, growth, income, cash flow? So they're going to try belatedly run out of Amazon and try and run into AMD. In and of itself, that might by itself be a good move. But is it a strategy you've tested? Does it have more than just, I just get out of what's fallen last week and get into what's rising in the news? Okay, the fact that I own AMD or Micron is not, all the way down here, is not because of Trump or news. It is because the solidity of the companies, or for that matter, ASML. And the fact that I do happen to have NVIDIA and Microsoft and they're down doesn't make me panic and want to exit them, any more than seeing Starbucks, which is on a slightly upward momentum trend, is not one that I have, but I know is one which, if I had a purely momentum thesis, I would want. So let's work out how we should be investing and how we shouldn't be investing, and teach you those elements so you don't fall into noise and panic traps, but still have good quality companies, the likes of which you'd be more than happy with as well. Okay. So let's get into some of that. Now, I'm going to go into some themes right now. This is the past week, and this is a map of various themes. Okay. It might be a bit difficult to see, but I'm going to run into some of this. Now, let's take gold. If I take something like gold, whether it's buying physical gold or whether it is buying, say, a selection of gold companies, and let me run into some of the names. I'm not necessarily saying I'd have these, whether it's Kinross, Goldfields, Kerr Mining, Newmont, whichever one of the gold, whether it's the mining companies that you can see where it says gold over here, or it is the physical metal itself. And similarly with silver, whether it's ticker symbols like EXK, okay, or HL, or SVM, it's only going to have 5% of my portfolio. Okay, so whether it's silver core metals, and I don't own any of these, by the way, Endeavor Silver Corporation, or as I said, or even AG, which is First Majestic Silver Corporation, or Dolly Varden Silver. Is I could throw names at you, but what you'd say to yourself is, well, if I want some exposure, Alpesh, in a world like this, I need to know the time frame, at least 12 months. I need to know the purpose of the investment, diversification, dampening of volatility. Then I need to know, well, do I need to dampen volatility? I don't. I'm quite risk loving. So the most I'm going to have is 5% gold coins of my total investable assets in my portfolio. And in this case, I don't have any gold. My wife does. She has some because her portfolio is different to mine. Let's go into some more then of these. Now, you might look at these. You might say, whoa, wait a minute, Alpesh. Foundries has caught my eye. I mean, if this is the post-Trump or the new Trump January movements, then you might be looking at themes. Now, this is not how I select stocks. As you know, I look at value, growth, income, cash flow, Sortino. But let's say you did look at foundries and you said to yourself, hang on, semiconductor foundry companies, the likes of Global Foundries, Intel you've heard of, Taiwan Semiconductor, which I happen to own, United Microelectronics, these are all pushing things higher and are likely to stay stronger. Well, that's got nothing to do with Trump. That's got everything to do with AI. So again, think longer term, think what the fundamental aspects are. By fundamental, I don't mean theme. I don't care for themes. Just be absolutely clear. I'm putting this up because I know people care for this. I don't care for themes. I care for the underlying companies. So the reason I might have a Taiwan Semiconductor is because value, growth, income, cash flow, Sortino, all of those factors that I look for, okay, are ticked. Let's look at memory, semiconductor memory companies, up just, 12, 13% in the past week. And after Trump's speech, they're going up even more because people are thinking, oh, actually, he seems to have backed down a bit. Taco, Trump always chickens out. Now, again, Micron comes into this, Rambus comes in, Seagate, Western Digital. However, again, with all of these, and Rambus has actually been one of the better performers, I don't own all of those. The fact that I own Micron but not Rambus is because it'll be down to the individual quality of the companies. And the point here being, don't be overexposed by narratives of themes into one singular theme. It is the quality of the company and its resilience to things which are falling, which matters. Now, you might say, bloody hell, Alpesh, data centers, infrastructure. We know data centers and infrastructure should be doing well, but they've been taking a bit of a hit. Of the few which have not been so bad, nVent Electric, PLC, nVent Electric hasn't been hit as much. You've got Super Microcomputer down there amongst them, and you've got Dell, but they've not really been soaring except for this past week or so. So just randomly going into, well, there's a theme, I'm sure I'll do well if I pick stocks on it. It's a really bad way of doing things. What you should be looking at is putting the narratives and the themes to one side and saying, right, where's the balance sheet? Where's the P&L? And if you do try to gamble on themes, I suggest you don't do it with your pension money. Let's go to drones, okay? Because we know with conflict that drones are right up there as the most critical infrastructure likely to be bought with all the conflict and war, maybe even the Greenlanders will need it. So who are the big drone theme companies out of defense and aerospace? Well, part of the problem with this is most people don't even realize. Now, all of these companies I'm about to mention are multi-billion-dollar companies, okay? And the fact that take an L3 Harris or Kratos Defense and Security Solutions, Boeing, you've heard of, well, Boeing does a lot of other stuff. Ondas, Red Cat Holdings, RTX, Textron. The point with all this is we're not going to just randomly spray and pray and say for marketing literature, we're covered with drones. Don't worry, space tech, missiles, and cyber defense companies. The far better thesis is not the one which your mind is telling you right now. Are you bloody kidding me, Alpesh? Tell me about missiles. Tell me about missiles. It's got to be the way to go. I've got to know who's big in missiles. Tell me about General Dynamics, Lockheed, Northrop. Again, RTX, L3 Harris. And I'll say, well, no, because you're taking a gamble. And that's the nature of people. They take gambles. They don't look at the data. They don't look at value, growth, income, cash flow. Sortino. Hey, Alpesh, tell me about space tech and satellites. Surely that's going to continue. Yeah, you're right. Satellites, AST Space Mobile, Global Star, okay, Iridium, EchoStar, Telestat, Viasat. But what if I told you that actually 3 of those have got really bad balance sheets and poor cash flows, and the other 3 are actually better? Surely then you'd say, well, actually, yeah, I want to know that. I need to know that. Or with uranium, somebody wrote a really nice uranium article, and I think we need uranium. I'll come back to Trump and Greenland in a second as well, that we really need to get into uranium. Is it Chemco? Is it Denison, Centrus, NextGen? Is it Uranium Energy Corporation or Energy Fuels or NewScale? Which one of those is it, Alpesh? Which one of those is it? Well, actually, you might well think in a portfolio of just 20 equities, you might only want one exposure to uranium, if that. Surely it's about balance sheet, cash flow, valuation. Is it an undervalued company that's growing? Whether it makes uranium or it's in livestock, does it really matter? Don't fall for the sexy label. Oh, no, I know what your brain's saying. It's saying, no, it's got to be the sexy label. It's got to be the sexy label. Okay, if you want the sexy label, do you really think it's going to be supplements or metabolic healthcare companies which are going to be better, or is it going to be space tech? You'd think, oh, well, it's going to be one over the other. So, like I said, we've got a lot of names. We've got all this data, and we don't narrow it down by themes because the academic literature shows that going for themes in short-term basis is bound to lead to trading and underperformance and poor returns. Okay, so you're going to hear a lot of this, and you're going to hear it because of Trump and Davos. They're going to come up with themes because they're trying to sell you movement and panic and stories. And the worst thing is you might get lucky and pick the right stock in the right theme. And what happens 2 minutes later? It's all changed again, and you've got to keep changing. So what else is happening? Let me tell you what's happening right now. It's market caps. What we're being told is things are moving from the big market cap to small. Well, you tell me, is it? Okay, it's definitely moved out in the past week from the mega caps, but ExxonMobil still up there. AMD, Micron, Johnson & Johnson, ASML, of which, as you know, I've got AMD, Micron, ASML. But wait a minute, this doesn't all look full of greens. Actually, the mid caps are doing better. And the nano caps, well, hang on, why would that be the case? And I'll tell you why. Big funds with lots of money find it difficult to find small and micro cap companies for the simple reason they'd end up taking them over because the fund has so much money, they can't put it into a small company. Nano caps, the really small, high risk Vegas kind of play, you've got a whole group of retail clients based out of Miami who are more than happy to buy nano caps all day long. If you want to gamble on that, good luck to you. You might get lucky. It's great fun. So is going to Vegas. So you're left with mid caps. Would you want to diversify by market capitalization? Not necessarily a problem, not necessarily a bad thing either. However, might I suggest that the market cap factor, the factor of market capitalization in terms of moving stock prices, if we look at all the statistical data, whilst it could be correct for a week or two, over the longer term, whilst it is a factor, the size of companies, and it's always been thought, certainly was true in the 70s and 80s, smaller companies would do better than bigger ones because elephants don't dance, basically. Big companies don't dance. That's not been true for about 25 years. I wrote a column in the Financial Times that elephants do indeed dance, okay? And that's all changed because the funds have got bigger and they can only put into these big companies and they can make them double, which is why big companies go from $1 trillion to $2 trillion to $3 trillion. So again, be very careful about people in the light of Trump and Davos and all the rest of it saying, yeah, there's a rotation into a broadening out into smaller caps. There isn't. There is some into mid and large, but that unless that's based on the underlying quality of the company, it is purely momentum chasing on a narrative. And the danger with momentum chasing on a narrative, as opposed to a conviction buyer based on undervalued companies with high growth, is then it's hot money, and hot money leaves just as quickly as it got in, and you are trading and you are more likely to panic when that hot money leaves. So what you're far better off doing is saying, okay, I've got a company which is undervalued and growing and happens to be large cap, great. Rather than it has to be large cap first. You've got to think, what are the important factors not what's the narrative. Okay. So we're not seeing it out of these companies. We are not seeing out of these companies a reason alone to move into large caps and mid caps, unless those self-same companies tick all the boxes on value, growth, income, cash flow. Equally, we do not yet see it any reason to leave the biggest conglomerates, the mega caps, because the mega caps are like Trump personified. They are imperial corporations which will bankrupt any competition they find in their way and hire their staff, destroy their competition's profit margins. They will absolutely, like locusts, eat out anybody who deigns to compete against them. And if they can't do all of those things, they'll litigate them. They will destroy them up until the point they've got no other choice other than perhaps to buy them out. But they will do whatever it takes, including crossing the line into things which are illegal, because they will test the legal system on the laws on monopoly and collusion and all sorts of things. Okay? Take it from a barrister. They will do that. It's in their nature to do it because they have Rottweilers for lawyers who get paid by the hour. They get paid a lot of money to cause a lot of trouble for a lot of other people. So we don't see a reason. The defensive moat of these companies still exists, the intellectual property that they create and the patents that they churn out as a means of making sure nobody else can go near them still continues. So that part of the story hasn't changed for us. So be very careful what you see in the press. Is a lot of people think, oh, the large caps, it's the year of the small caps. They may well be right. Those indices may well do well. But that in itself is not a hypothesis on which to base a decision that, yes, I think I'll just go in and buy those of themselves. Let's look more at the past week. Again, in terms of countries. So that title shouldn't say market cap. It should actually say geographies. Is the money moving somewhere we don't know about? Now, every single company you see there is listed on the New York Stock Exchange. You can go to your SIP or ISA. Okay. But the issue then becomes for us, not, oh, well, let's diversify into South Africa. If we were doing a marketing gimmick for LNG funds or for St. James's Place, that's exactly the kind of BS we'd come up with. Don't worry, we're well diversified. We've got some South African companies we'll throw at you and even some Canadian ones, etc. No, we still need to look at the company and is it a good company with a good balance sheet? The fact that it's gone up 8% in the case of GFI in South Africa in the past week is not reason enough to buy something. It is the reason retail clients do it because they look at things upside down. Okay, we'd prefer to look at something which has fallen and say, oh, has that just got cheaper? Has it got a good balance sheet? Is it undervalued? Is it high growth? Okay, so, and we're equally not going to, as I'm going to show you in a second, make the mistake that private investors make is looking at individual stocks, but we're going to look at the portfolio and the football team as a whole. Okay, so in and of itself, Petrobras got no problems, but I need to see, is it undervalued? Is it growing? Otherwise, you are doing what the same mistake everybody else makes. They read an article, see a webinar, and they say, oh yeah, he said buy PBR, buy SML, all this. So we throw all of these companies in there, as well as every single one of these, all poured into the data to see which ones are undervalued, high growth, and dividend yielding. Because we can't look at all of these individually. We do have to then filter them out based on valuation, growth, historical performance, historical drawdowns. And we're going to show you a bit of what that looks like in a second. So this various exchange traded funds over the past week as well. And certainly one thing's clear from the JP Morgan events and the reports, and I'm going to show you all of this stuff in a second. I'm going to show you what every single analyst thinks as well on Wall Street, and we've summarized all of that and the big issues about Greenland ultimatum, agentic AI, Sananomics. I can't say it. Basically, Japan, Fed independence and critical minerals race. We're going to cover all of that and see not which stock is going to be the beneficiary. There might be a bit of that. It'll be what provides a solid portfolio, which can get, for me, it's a 40% per annum target. Okay, is it realistic and likely to? It's no guarantees. Might do it, might not. Okay, but at least we're aiming for that bar. And if you don't meet that hurdle, then the stock's not getting in. If it can't contribute to the team, then the team we're putting together is, I don't know, Real Madrid meets Barcelona meets Brazil. That's the team who meets Argentina, meets Germany. That's the bar. We're not meeting, the team we're putting together is not Leighton frickin' Orient, right? So, in terms of this, 5% gold, fine. Too late for gold. Well, we're not trading it. The only reason to have gold in a portfolio is as a diversifier, as a dampener of volatility, and you'd only max that out at 5%. Anything more than that, and you're trying to trade it. And if you want to go and trade, good luck to you. But there's a very simple trading strategy if you want to use it on any of these ticker symbols. And the trading strategy is basically, if the monthly MACD is rising, be in. If it's falling, be out. It's not perfect, but you'll be fine. Okay, it's not the greatest strategy in the world, and I'll just show you it. But if you really want to use that on a ticker symbol, including the S&P 500, then that's probably as simple as I can get for you. And you can look at this on Yahoo Finance as well. Look at the monthly, and if that monthly is falling, you probably want to be getting out. And if it's monthly is rising, you want to be getting in. And there might be times where in a week or a month, you have to get in and out. But most of the time, you'll capture the bigger trends. Okay? It's very simple, right? That's not good enough returns for me because that would only generate 15% per annum, which only means doubling your money in 5 years, which isn't good enough because that's historically what that strategy generates, because it tracks the S&P overall. All right. That's slightly better than the S&P, but that's what it does. So that's not really the game. But if you wanted that game with any of these, it works because exchange traded funds are a basket of stocks. And so they have that smoother movements, which moving average prices, which is what I just discussed, can follow through on. But that's not the way we do things, because we've got a higher benchmark than that. We don't just want to be the best football team in the Championship or in the Scottish leagues. We need to be world class, not least because it's my son's inheritance that we're talking about. So with this, again, themes, no. ETFs, they tend not to have, with the exception of leverage ones, which don't do because you shouldn't be doing leverage, or inverse ones, they tend not to have the kind of returns we generally want, other than for short spates of time if they're leverage. Just because they're a basket of stocks, and baskets of stocks tend to have a dampening effect where some will go up, some will fall. So they tend not to give us the kind of outsized returns we generally want. And I'll give you an example. If you look at China and you look at Yang, Y-A-N-G, not so much for us. I'd rather have Alibaba stock, which I don't own in China, but I'd rather have it. I can't own everything. But the volatility of Alibaba, I don't like, which is why I don't own it. Similarly, I've no doubt Alibaba and Tesla will both do very well over the next 5 years. I don't want them because I don't want the volatility. And you probably, if I don't want it, trust me, you probably don't want it because you will panic, okay, and exit prematurely. That's the major problem. So here's a WhatsApp I got from a client. He said, could be some massive drops if the EU and USA get into an economic spat. What stocks will likely drop or do well? Okay, any idea? So I replied back to him, and really the important thing isn't, don't go and, you're not going to buy these, okay? I'm not going to go out and buy these. The important part of the message I gave him was this: trying to preemptively rotate in and out of individual stocks based on geopolitical headlines is rarely successful. The better defense is avoiding overconcentration in fragile cyclicals, favoring quality and pricing power, which is what we always do in our portfolios, having clear rules-based exit points for genuine regime change occurs. Okay, even high-quality stocks can fall in a macro scare. The difference is how far they fall. You want quality companies tend not to fall as far, high sortinos, in other words, high average returns, lower falls, and they're quick to recover. So I explained this to him. I said, financials are often said to react badly to uncertainty and growth, but given Trump's speech, they might now be okay. Cyclicals, travel, consumer, Rolls-Royce, EasyJet would tend to energy and materials, but you might equally think, wait a minute, global uncertainty, surely energy should do better because people are worried about conflict, and doesn't oil do better then? So shouldn't Shell do better? Didn't ExxonMobil just go up a lot? The point is, if you purely do it on a message like this, hey, shouldn't there be some gamble we can do? That's what it becomes, a gamble. Okay, and this is typical of how journalists will look to do stories and brokers will look to do stories. They will put it in this format, and I can give you names, but you tell me. And I'm being absolutely honest with you. Okay, with all my expertise and experience and everything else and all these books that I've written, you tell me, surely, aren't we thinking, wait a minute, Anglo-American falling, but it's a mining company. Global concerns, shouldn't that mean it goes up? What? Oh, no. Tariffs and global trade GDP dropping should mean there'll be less demand for energy and materials, so it should drop. My point is there's a narrative for every single one of these pros and cons. Okay, for every single one of these, and give you a beneficial or a non-beneficial. So the narrative alone is not a way to pick stocks. Stop doing it. Okay, because you're being tempted into it. And occasionally you might get right. In the same way I get right when I say the narrative is buy red, it's a lucky color when you go to Vegas. And just because it comes up red doesn't mean I've got some special skill, or that superstition about the color red being a lucky color was right. Right? And that's the mistake private investors constantly make. Don't take my word for it. Richard Thaler, Daniel Kahneman both got the Nobel Prize in economics for pointing these things out that I'm pointing to you right now. Okay. By the way, this is what's going to happen to the S&P 500 this year. And it's what's going to happen to a typical portfolio with $100,000 in it. How do I know this? Well, I'm going to let you into a secret. Portfolios and indices all have statistics. And statistically, a 15% volatility, which is the annualized volatility of the S&P 500, but also of a typical private investor portfolio, so volatility means something and statistics mean something. And it means these things. What you see on screen. We created an app for our clients so that they could actually input this themselves and their own portfolio numbers and come to the conclusions themselves. But it means that there is a 1%, a 1 in 100 statistical probability that over the course of a year, a £100,000 portfolio with a 15% volatility would drop $34,000. That's statistics. It's not guaranteed to happen. There's not guaranteed that 1 in 100 times that would happen. It's not guaranteed. They're not predictions. It's statistical. Okay. So there's a 1 in 4 probability. And this you'll easier understand that in a day, your portfolio could lose $633. You go, well, who cares? It's the pinks that you care about. In a month, there's 1 in 100 possibility you'd lose 10% in a month. Okay? 10% in a month. Now, the reason I show people this is we want to inoculate them against panic. What we also want to do when you look at something like this is you start thinking, hang on, so if an extreme move happens, this almost suggests to me I should be buying that dip. Unless there is something fundamentally wrong with the company. In the case of a company with an index, the benefit of an index is there isn't something fundamentally wrong usually with an index because it's a collection of companies. An individual company could have something wrong with it. It could be BlackBerry meets Apple. Boom, if anybody remembers BlackBerry. So the point is with this, I look at this and I look at the pinks as positive. You might look at the pinks as negative. I look at the pinks and think to myself, that's the opportunity to start getting in, buying more, and not to worry because we've seen it before. The statistics tells me it's going to happen. You look at the pinks and think that's the point at which I need to buy more Andrex. Okay. So the reason I'm showing you this is one of the best ways to inoculate yourself against Trump kinds of panic. And the man is there to cause panic. He mentioned it in his speech. Okay. And he gets an enjoyment out of causing world leaders panic. Okay. The reason to show you this is to show you to keep calm and most of the time do nothing. Unless the individual stock you have has suddenly become like BlackBerry and its market's dead. Now, here's something else why you don't even need to do anything in that scenario. And the reason is this. If you've got 20 stocks in your portfolio and each of them has 5% of your capital in it, then you don't need to worry on the basis simply that it's just 5% of your overall portfolio. And let's assume you've not got the kind of company that's going to go to zero. So you're not even going to lose 5% on that one stock, doing what some stocks out of 20 will always do. Whereas most people are trying to be, as retail clients, perfectionists, and they foolishly think that they can get every single thing right, or they should be going for specific themes, and they're looking for perfection, and that's how they end up losing money instead. Now, I'll come back to Trump in a second. AI investment, a sustainable boom or bursting bubble. What's out there? Well, for a start, the valuations at the moment are actually quite reasonable compared to 1999 peaks. We've also got profit that's leading this growth. Okay, we've had a 13-fold increase in profitability. It's not speculative price appreciation. So we've got some fundamentals behind and underneath the market. Nevertheless, I guarantee you this is going to happen to the S&P. At some point this year, this is going to happen. Now, I'll tell you what the worst case is I'm going to put in. I'm looking for that. I think that's going to happen. Any fall below that, I'm going to be buying shed loads of it. So we get any of these moves, I'm going to be stocking up on the S&P 2 times leverage. Okay, so I'm sorry, that's not below. The others are 14.7. That's how much it's going to fall at some point. How do I know that? Statistics. Just plain statistics. Well, you're not really, Alpesh, because she's got a very little probability of that happening. Yeah, it's going to happen this year. Now, speculative pockets are outperforming. Yes, quantum computing is up 83%, as I showed you. Bitcoin sensitive, some of those are up. That's the froth. The themes are the froth. That's where the micro bubbles that I showed you earlier with the themes are happening. Unless the companies have value, growth, income, cash flow, you can trade those themes, but you're more likely to get your fingers burnt. Okay. Now, compared to 2000's tech leaders, the 2025 Mag 7 do not show worrying signs of bubbleness. So the recent falls haven't fallen enough for me to want to buy those dips. All they've done is say to me, yeah, nothing much more for me to do in those. Yes, there is a warning sign that there's a growing reliance on debt with the hyperscalers. But again, I'm not too worried about that as long as interest rates remain relatively low. So in light of what Trump's just said and Greenland and the trade bazooka, what's the overall picture to put that in? It's very easy to have a cognitive bias or recency bias, where the last thing you see, you think is the most important thing there is. Let's put that into something of a context, okay, of what's going on. Well, we're getting 2.8% global growth amongst the biggest markets. That's the forecast. The IMF think 3.3, Goldman Sachs 2.8, United Nations 2.7. Those are their factors. And my clients have been given various summaries and reports and infograms about all of this. And now we've got the rise of physical AI, embodied AI in factories, in logistics, in humanoid robotics. And then you've got sovereign AI and green computing. Nations are investing over 100 billion in local AI infrastructure to ensure data security and energy efficiency. So sovereign AI, that's where the government, like defense is a sovereign realm. You don't really have, you don't have warships held privately. The country, the nation holds our defense. You don't have private nuclear weapon companies. You have they're under the remit of national security. So similarly, sovereign AI, the bits that's going to be owned by the government, that spending and the spending by the Mag 7 means that there's a lot of money in the system being spent. Previously, governments were the only ones who could spend the kind of monies that NVIDIA spends. Now, those private companies are able to do it. Just as the East India Company became so powerful that the British Parliament got involved and the Crown was afraid of the size and power of the company. It's just history repeating itself. These companies are going to get bigger and bigger up until the point America again reinstates its antitrust or anti-monopoly legislation. And the reason it has that anti-monopoly legislation is because they broke away 250 years from a king and they didn't want corporate kings. Now, they seem to have put all that in abeyance and forgotten about their roots. And that's fine because I own shares in each one of those modern day East India companies and Dutch East India companies. But it's really been the corporations which have built empires under the guise of an emperor to protect them. And so I don't have a problem with owning, Meta, Microsoft, Apple, Amazon, Alphabet, NVIDIA, especially given the funding which is going in to grow the rest of the economy. But I'm not going to be looking for tiny nano companies, and you're not going to get me spewing out nano company names to you as well on a speculative basis. It's fun to do, but it's not for me. So what have we got on the geopolitics? Well, apparently there's some kind of retaliation package, the bazooka, that the EU can do. Okay, it's an anti-coercion instrument. They don't want to do it. Trump always chickens out anyway. There's the Greenland tariff ultimatum. US threatens European allies with 10 to 25% tariffs. Tariffs come and go. The market's given the green light. Do whatever you want with tariffs. Tariffs are actually working in the US government's favor in this regard. First of all, we know the increase in tariffs last year have not led to recessions, hasn't led to lower growth, i.e. negative growth, declining growth. It might have been that were there no tariffs, growth could have been even better, but then that could have been inflationary. So what tariffs do, which is their attacks, is when you've got such loose economic policy, i.e. low interest rates, they take some money out of the system. And currently that American tax is taking money out of the system. Trump knows tariffs are working for him, because what they're doing is they're giving money to the US government, and that's reducing the budget deficit. And it's keeping inflation under control. Okay, and you might say, wait a minute, surely tariffs put up prices, so inflation should go up. No, they reduce spending and cause substitution to lower cost items in any event. But we don't need to theorize this. We've seen it over the last 12 months. The bloody things have led to a stock market all-time high based on profitability and earnings. Basically, if he didn't have tariffs, he'd have to get Congress to raise taxes because he wants low interest rates and he doesn't want them to raise taxes. So this has been a phenomenal backdoor secret weapon for him. Give him the Nobel Prize in economics if you really want. And that's why adding 10 to 25% and using Greenland as an excuse, which is soon to be called Trumpland, exact same number of letters, somebody's going to point it out to him, it's actually not negative for the US economy. It is for those of us who think, oh, well, sure, changing world order, we don't like changes, and what about the rule of law and all of this? Yes, of course, on all of those things, but I'm talking markets right now. I'm talking markets. And I really want to believe it's bad for the world and we shouldn't have a world where might is right. Of course, I want to believe all those things, and I do believe all those things are wrong. But what I'm talking about is purely in terms of making money as an evil capitalist. That's working out for me. Thank you very much. And it's working out for Trump and the US economy at the moment. Thank you very much. So I've not got panic stations from that. I then look at JP Morgan, Goldman Sachs, you have all these sort of GDP global forecasts, and we're all positive that roughly 3% for JP Morgan, roughly 3%. Okay, that is positive. Now, I'm not trying to sell you a retail fund where I'm like, hey, everyone, we should all be happy. I'm just telling you the way we're reading it. Japan, do I want a Japanese ETF? Yes, I do, I think, as a diversifier. Got some wage increases. There's some worry about their bond yields. They've had a Liz Truss moment with bond yields spiking, but that'll come back in as they realize the bond market runs countries, not their economic ministers or their prime ministers. So yeah, I might put, I don't know, 3%, 3%, 3.5%, something not meaningless, but equally not something beyond 5% in a Japan ETF, and it's something which will be like gold for the longer term. Okay, but when you look at the AI paradigm shift, that is real. That is leading to productivity. Unemployment, by the way, in the UK, and it's not down to AI, is I think 2021 or 2019 levels. It's roughly about 5%. The way Labour works is, remember, it is a party for the workers. Okay, for the workers, not the unemployed, the workers. If you decrease the number of people in employment by increasing wages for them, you are still a party of workers because they're in work with higher pay. The fact that a lot of people became unemployed is not of their concern. British economic history. From the time, 1893, when the independent Labour movement was created, which then subsequently became the Labour Party in the early 1900s, it is a party of Labour. Those actually working, not a party of people not working. So in that regard, they're doing what they promised. It's very unusual for the UK markets to beat the US 2 years in a row. It's happened once in 30 years. Is it going to happen again this year? Yeah. If you want to diversify, sure, be my guest. 2 times leverage. FTSE 100 is what my weapon of choice is, but I wouldn't have more than 5% of my portfolio. In fact, closer to 3 because it's leveraged anyway. Okay. And then the agentic AI stuff, that's not bullshit. It's there. It's happening. So I'll give you an example of a typical portfolio from 2013. It's one of our client portfolios, okay? From 2013. That's the number that would always scare us. Now, the beauty with this is even if he does half of this going forward, he still doubles his money then in 5 years instead of 2.5. But the point is this. The trick with the clients is to get them to realize, don't panic and don't get bored during these periods of drawdown. Don't panic and don't get bored. And this is what his portfolio looks like year by year. And let me tell you I want you to remember that number. What 32.3%, which is massive. That's doubling your money in 2.5 years. What that looks like year by year. What it means is you've got some companies which go up almost every year, but look at that. They can drop 28% in a year. Yes, people saying, oh, if it drops more than... There are other companies which drop 40. There are some which drop 64, 39. There are some years like 2022 where almost half of them have dropped, half of them have risen. There are companies where 2 consecutive losing years before you had a 72%. Okay? What I'm saying to you is this. There hasn't been a single year in his entire life to becoming the world's richest man that Warren Buffett had a portfolio where every stock went up every year that he held. Oh, well, Alpesh, you're close. Why could you not see that 64% drop? Well, I could no more see a 64% drop than I could see the 194% rise, because if I could see those two things, I would today be the richest man in history. And anybody who tells you any different through narratives is bullshitting you. Anybody who tells you, well, we looked at the data and we held it because all the numbers look good, etc., and yet it still dropped 64%, they're telling you the truth. The trick isn't getting all the squares to be black. The trick is to make sure that when you win, you make more than you lose when you lose. It's as simple as that. Okay? And there isn't a single stock in there that I can see which has gone up every single year. In fact, there isn't one which hasn't had a 10% or more down year. I don't think. Every single one of those stocks, if I'm not mistaken, you can write it out in the thing, has dropped at least 10% in the holding period, at least 10%, and some more than once. Okay, that's critically important to understand, that you got to look at it at the portfolio level, and you're not trying to be right all the time. You're not looking at themes. You're not looking at stories. You're not looking at panic. You're looking at undervalued, high growth, dividend yielding companies at the portfolio level. For us, when we did the same exercise last year, these are last year's stocks. They're not this year's. Okay, that returned 58%. But that should immediately ring an alarm bell, which is, yeah, but Alpesh, didn't the stock market do well last year? Yes, it did. But wait a minute, Alpesh. If you did 58 at the portfolio, how come you didn't just pick one stock because it went up 161%? You would have got 161. Yes, because we can't see which one's going to do incredibly well and which isn't. Do you see the limitations of what? And when I tell you, you think, oh yeah, that's actually obvious, because even Warren Buffett doesn't have just one stock. He has more than one because he can't see beyond a portfolio. It'd be too much risk to say, oh, I think it's HOCTF who are going to be the winner, or Filtronic, 142%. I wish I knew 12 months ago when this came up all green on our filters, that's the one, because I would have put everything in there and I would have got 142%, and we would all been, I would have leveraged it. I would have borrowed 20 million off Goldman Sachs and said, I'll pay you back in a year. Here's your interest, 1.6 million pounds. And with the 20 million, I would have pocketed my 30 million in profits, paid them their money, and walked away with a cool 27.6 million pounds. Okay. And these are some of the others, but this is last year, and you'd rebalance back to equal weighting, but we're not going to hold these this year.
I do happen, because of another portfolio I've got, to own Jabil and Ralph Lauren, but I don't think I've got any of the others. Filtronic, I think, is in there as well. So you're not holding year upon year. And when you do that across different clients, they all have different risk profiles. Some don't want to see any wobble. Some don't mind. I had one today, he's in his early 40s. He said, I just want to make as much as possible. I don't care how much when I own it, it goes up and down. And I said, well, probably better for you is something like the Dinshaw portfolio, which can have high move, can move like this, but overall tends to do rather well. Whereas others won't do as well. They might only do closer to this model UK one we've got, but they tend not to be as volatile. And there's an interrelationship between volatility and return, or risk and return. Okay, so what we're looking for. By the way, to make that point I've just made to you, the London Stock Exchange top 20 stocks of last year were these, and their percentages in the US top 20 were these. Okay, we're not in the business of trying to pick these. We're not in that business saying, oh, it should definitely be BYD. I wish we were, because 1,700%, but we don't have a methodology for that. We literally don't have a methodology for that way of doing things. And I'm trying to see if I own any other ones in the top 20. No. Nope. And here's the interesting thing. If you put this list together of the US top 20 stocks, from the time Warren Buffett started investing to the time he retired, never once in any year did he hold one of the top 20 performers, and yet he became the world's richest man. Whereas what private investors are trying to do is go for the headlines, must go and get this stock, must go and get that one stock. And by the way, the fact that out of the exchange-traded funds, it was mainly gold, well, like I said, so what? Most I could ever have is 5% of gold anyway, or silver, or a mining company. So, and is it too late now? Well, if you're going to do exchange-traded funds, as I mentioned before, if the monthly MACD is falling, you better get out. And if it's rising, you can stay in. It's as simple as that. I want to very quickly run through. We've got quite a bit, so we've got a bit of time. So I'm going to do some Q&A as well. So going back to Trump and looking at the major issues, and hopefully now you understand some of the key points of how you should be looking at stocks as well. So what are the major things that are coming up? Well, global growth is pretty good, despite the volatility of NATO, despite all the various risks that we're well aware of. We are aware of it. We're not blind to it. Okay, we're not blind to the things you see on screen. We see the growth engines. We see there's a bit of danger on inflation, but it's not going to impact our portfolio. And probably what we'll have to do this year is nothing, absolutely nothing. Okay, because we've looked at the fact that everybody thinks it's going to be an up year. Yeah, we think that there's going to be a 14% drop at some point, but overall it should be a positive year. And what's that being driven by? In a way, it's being driven by companies being given the opportunity to do what they always do, which is to make profits in the case of the big tech companies because of AI, amongst other things. As long as companies can make profits, we're fine. And that's what's happening. Now, you might say, well, no, drill down a bit deeper. Okay, large action models, agentic workforces, okay, robotic agents as well, if you really want me to. But what does it matter? It's not my problem. It's for Microsoft to work out that problem, or Oracle to work out that problem. It's not for me to work out that problem. And now we're getting physical AI, machine learning, robotics, sensors, actual human models. And of course, the growth in sovereign AI, which means governments are joining in. These geotech spheres where infrastructure has to be locally domiciled, and America's going to ask for its pound of flesh on that as well. Okay, so I'm happy. Quantum. Now, I could tell you quantum computing companies, but the problem's going to be, unless balance sheet, P&L, what does it matter? What does it matter? And of course, the massive energy demands. It's not my job to work out, are these companies going to be green? Which speculative green, tiny nano company should I invest in? That's for the job of the stock, the board of the company whose stock I've bought. So if I happen to buy, I don't know, Micron, then, or JP Morgan or Goldman Sachs, it's for their board to work out what the issue is. And in case you're wondering what I mean, that's NVIDIA. 4.6 market cap. Its market cap is larger than the British economy. Okay, I know I'm measuring apples and oranges. The market capitalization of one company created in America is worth more than the entire gross domestic product of every single man, woman, and child in the United Kingdom in a year. Right? So when I say East India Company, that's what I'm talking about. And when they spend, it is more relevant on the world stage than when Britain spends, let alone the fact that we've got a budget deficit and we've got worse financials than NVIDIA does. NVIDIA is profitable. We're not. As a country, we're not profitable. Our national debt increases. Okay? So, return of raw power, the Greenland ultimatum. Is that a problem? No, it's noise. It's noise. There's the tariffs. S&P reaction 2.1%. 2.1% is nothing, as I've shown you earlier, on the probability moves of the S&P. But there's another reason why it's nothing. People need an excuse to take profits. When I used to do my Bloomberg TV show and there'd be down days in the market, I'd say, hey, listen, they're just taking a day to take some profits because we've had a lot of profits to be taken. They need an excuse. They got an excuse. What happens if they initiate the trade bazooka? Well, we're not trading. This isn't a trading floor. None of you are here to be traders. Trust me, you might think you're traders. You're not traders. So for those of you who are thinking, yeah, I think we should buy Boeing, Lockheed Martin, Amazon, Microsoft, Google, could they be hit or not hit? JP Morgan, Goldman Sachs, yeah, they'll all take something of a hit now and again. And if not, then somebody else. But we're not chasing that because when that happened this time last year, a lot of companies that nevertheless went on to make all-time highs. So we've got to decide, what are we, investors or traders? If we're investors, we've got to look beyond it and got to look at the solidity longer term. And if we're traders, we better trade. In which case, yeah, follow the noise. Follow the noise. Okay? What about institutional independence? As they said at the JP Morgan private bank event, who cares whether the Fed is independent or not? Some of you might not even have followed this. Okay? Now, here's the issue on succession. Kevin Hassett, growth at all costs. He wants growth, growth, growth. Kevin Walsh, unlikely to get it because he wants price stability. Trump wants growth at all costs. So he's going to go for Kevin Hassett, almost certainly for next year. All right? And he'll need somebody serious because otherwise bond yields can spark. And who knows? Who knows? Powell might just say, screw it, I'm going to retire. A bit like the chief constable in the UK who just goes, do you know what, time to retire. So what's happening with new Trumpland? So he's going to call it Trumpland because if I've thought of it, he's thought of it. What are we looking at? Well, okay, Tambries, rare earths, $3 billion, 180% internal rate of return. In other words, 180% per annum return. Okay, there's some money there. Does that affect the stocks that I'm in? No. Is it going to affect it through economic noise? Yeah, in the short term. Do we sit through that panic? Yeah. Right? Are they alienating everyone? Yeah, they've been alienating for a while. The clock's running on Trump. Term 2, 3 years left. Japan, okay, simple. ETF, Japanese economy, and I'll keep it at that. Do you really want me to go into Japanese debt to GDP ratio, which has always been one of the highest, if not the highest of all the economic countries in the world? Because after 1990, do you remember in the 1980s, they were a competitor to the US? Whoa, has that gone? India's a larger economy than Japan's, although with a lot more people, of course. Okay, so Japan at most, binary decision, in or out. If you're in, 5% of your overall portfolio in a Japanese ETF, and that's it. If you're looking for a trade in the short term, should I buy it for this week? You are trying to be a trader, you're going to mess it up. Don't try and be a trader. That's one of the most important lessons I can give you today. Don't try and be a trader. US economy resilience meets self-inflicted risk. Well, tariff drag, it's a drag that they need. Inflation, it's not spiking. Recession risk, JP Morgan says 35% probability. I'd probably put it even less than that. Okay, resilience, GDP, that is incredible. 2.6%. Trump rightly said at Davos just now, he rightly said, we don't get the credit we deserve. Yeah, because he doesn't understand how journalism works. Most nationalistic populist leaders don't understand that the point of a journalist, and I'm telling you as somebody who's a host on CNBC, being a Bloomberg TV presenter, our job isn't to say, wow, that's really great numbers you've got there, Mr. President. It is to challenge. That's Western journalism. It is to say, it wasn't always like this. In the 1960s, it was, yes, Prime Minister Douglas Hume, you're absolutely right, sir. We should, I do apologize for being so rude to you, sir. That's gone. The age of deference has gone. He doesn't realize that. So he thinks they just hate him, which some of the media do. But the point is, 2.6% growth objectively is impressive. I couldn't care less who's the president of the US. That is impressive. I used to work in the US Congress, and it was the best experience of my life. It's why I never went into UK politics, because after you've done US politics, everywhere else in the world is completely irrelevant in many ways, unless you really, really care about when people's rubbish is going to be taken out, which God bless you if you do. But the point is, 2.6 is bloody good. And the American politicians know two things every single day. What will make growth go up? And what did the stock market do today? American politicians know that. British politicians can't spell footsie. Well, they spell it the wrong way for various reasons. Okay. So that growth is impressive. That growth has come as a result of policy decisions. And fortuitously for him, AI came along. He didn't invent it any more than Al Gore invented the internet. But luckily for them, it came along at the right time, that new technological innovation. If anything, the politicians didn't F it up. UK, GDP growth 1.4%. You go into the UK because you want value, not because you want growth. We don't have growth companies. And you've got lucky because gold has gone to all-time highs and we have a lot of mining companies. Other than that, if you want Europe, there's European ETFs. I wouldn't go into individual European countries necessarily, too difficult. So here are your geotech spheres. Okay, well, all the world's biggest companies are listed on the New York Stock Exchange anyway on their ADRs, or most of the biggest companies. So I've got 10,000 stocks to choose from. I don't need to open an account with the Shanghai B Exchange and then buy something through that in Chinese yuan. It just doesn't make sense for me. Or in Indian rupees, for instance. So I'm already covered by European, UK, global stocks in the stocks out of 10,000 I look at. I look at London Stock Exchange, I look at New York Stock Exchange, I look at NASDAQ. Okay, job done. That's 10,000 securities. So the old model, that new model, we are changing every single sector, largely due to what's happening with supply chains, because they've seen the fragility of supply chains in case of COVID and AI and Trump. So they're looking for more resilience. All of these little benefits are coming into the economy. That's positive, but it's a positive reason to sit still, not a positive reason to panic, and make sure you've got a quality portfolio instead. Okay, so this story is coming out a lot beyond the Mag 7, small caps, Russell 2000 index, if you wish as a diversifier, and pick and shovel. Okay, but how do we find those? I'll tell you how we do it. We look bottom up. We don't look top down narratives. We look bottom up. What's bottom up? Value, growth, income, undervalued, high growth, and so on. 5% max in gold. You can't do more than that, otherwise you're taking a trade. If you're taking a trade, good luck. You're a trader. You're not going to succeed as a trader. Okay. Regional alpha, yeah, overweight Japan. A lot of people are saying it. Don't have a problem with it. Emerging markets, no thank you. They always seem to be emerging. They always seem to be screwing things up. If you want to look at emerging markets, look at, say, something like India, INDA, okay? And you'll soon find, bloody hell, that didn't work out, did it? Okay? That's what will happen. Let me show you sectors in the US over the last 5 days. Okay, so you've just had spike in energy, yeah, relief. What else? All the major sectors in the last 1 day, i.e. right now, suddenly have gone positive from negative because they've just been relieved by Trump and his speech. Okay, but before that, over the last 5 days, guess what? Consumer discretionary, the worry was, well, the consumer's not going to have much money. Now we're all relieved again. Because Trump, when he meets you face to face like most bullies, backs down. He doesn't get all aggressive because he's got to sit in a room with people. I've seen it time and again. I mean, even when you put enemies together. Okay, so everything's now back to normal and we didn't need to panic all of a sudden, did we, Alpesh? Right? That's what it looks like, doesn't it? Let me give you this one in outline. The geospheres again. The bull case, GDP, as I said, equities doing well, US GDP. Bear case, global risk. Really? Are we? Structural volatility is a permanent feature. So what? 14% will handle the bump in the road. Agentic AI, you're going to keep hearing it. Physical AI, you're not hearing so much of. That's even better. Physical AI, even better. Gartner, 15% of work decisions made autonomously by 2028. I'd say about 70% of my decisions are made by AI, if not more. Return of Japan, good wage growth, good numbers. I don't mind having an ETF on Japan. I haven't got it yet, just letting you know. Resource wars, yeah, there's a resource war, but it's about renaming it Trumpland, all right? Because if he gets that, he's got a country named after him. It's as simple as that. He gets it, the American people are going to rename it Trumpland. All right? Is it about all of this? No. You can do that deal without, and he said he's not threatening military action either. There is money there. Who cares? It's not going to make a change. Battle for the Fed, I've already discussed. So where are we? I won't go into all of this at the moment, but at the moment, I know the companies we've invested in, whether it's the JP Morgan, I'll give you an example. Goldman Sachs, I was at their event, and they had pointed out just how much of their business is out of India, and how many Indian people they have. So they're an emerging market company. They've solved that problem for me. I don't need to have a separate investment there. S&P 500, where are we? Basically, it's now gone up again today after panicking and messing the bed. It'll go back down as people realize, oh, well, when Trump goes back on his aeroplane and gets angry again, it'll be volatile. So what does 14% look like? Okay, I think we're pretty much break even for the year so far. This is what 14% looks like. So I'm going to call it worst case 6,000 on the S&P. Would I buy into it at that point? Probably not. And just so you want to know what 14% looks like, that's less than the drop last year. And it happened last year, and you've forgotten because we had an all-time high last year. So why am I saying 14% at some point? Well, simply because it's a volatile market and they tend not to just go up and up and up. They didn't even do it last year. What does 14 look like? Whoops. It looks just a bit more than what happened in 2023, which was one of the best years in the stock market ever, right? 2023 was this, up 23% in the stock market with a 13% drawdown. Do you see the problem now? Why you're going to miss the 23% rise? Because the panic that happens in between, or the boredom that happens in between. It's the fact that you'll do stuff to mess it up. Okay, that will consistently happen in between. Now, we're at the hour stage, so I'm sure there's lots of questions. Surely it will collapse after some time. Yeah, the world's forecast to collapse as well. Let me answer a few more. What was the drop in COVID? We've got, if you look at some tools, Kavita, you can have a look for COVID. On those. They're at campaignfor1million.com tools, but just to show you what COVID looked like, it was 32. Okay. And then the rebound. COVID happened so quickly that you barely had a chance to move. But the bargains became so obvious so quickly. I mean, it was ridiculous that because of COVID, you saw some companies drop 50%. You're like, wait a minute, I'm getting this half price. What the hell's going on? It wasn't as easy I'm making it sound to navigate, but there was some benefits to it. Okay. Have a look at campaignfor1million.com for a bunch of free tools as well. And on the blog, I'm going to put these slides over the next couple of days. On a side note, you mentioned that Daddy Bear ruling on previous one. Could you remind me how this is checked for what MACD? Yeah, it's the monthly MACD. And it's if it crosses its own signal line. So if the green goes below the blue, and we're nowhere near it. But it always feels like it to people. How does one invest in UK residential property REITs? If you really want to, good luck. First thing you do is research it. And secondly, you go to your broker and the stockbroker online, and you put in the letters REITs, and you'll come up with a load of names. But then you got to find hypothesis to test those names on. I don't have one for you. It's not what I do, REITs. I look for greater growth than real estate. I'm looking for technological, artificial intelligence, quantum computing, nuclear fusion levels of growth for my portfolio, not property. Okay, Alpesh, where do you get your histograms for individual stocks? Oh, God. The team, London Stock Exchange. How does one... right. But the state is exploding. We'll follow the news. Very tiring lot. Yeah, you don't need to follow the news. Why are you following the news? What's wrong with you? Warren Buffett doesn't even follow the bloody news. At Stephen, he always says he will do it in the near future since I started following him. But it's a nice reminder. What is Alpesh? When will you do a review? Oh, God, you're so right. No, you're 100% correct. You're right to call me out on that. I'll make a note to just do one of ETFs. You're absolutely 100% correct to call me out on that, because I always say I do, and then I get around to it too late. Well, diversification is good. Well, diversification, do you know what it means? So if the market's rising, you don't want diversification, you want concentration, because why would you want things to fall when the markets are rising? So diversification has two meanings. Essentially, things to go in the opposite direction to each other, or be non-correlated. The one you actually want is the non-correlation, because it has a dampening effect. So I'll give you an example. Two stocks, both going up 10%, okay, in a year. Imagine I've got a time machine. I knew they're both going to go up 10%. One of them goes up like a sine wave. The other one goes up and down like a cosine wave. They cancel each other's volatility out. They both deliver 10%. So you got your 10% return, but they canceled each other's volatility out. So you got 0% volatility. That's what diversification should mean, okay? Dampening. However, sadly, what your typical IFA thinks it means is just randomly spray and pray things which don't look related to each other. So they don't look at correlations. They think they are, but they're not looking at the data. They're looking at narratives. And so what they end up doing is buying you things which have got hidden correlations. Eugene Fehmer, Nobel Prize economics, and Harry Markowitz on that aspect as well, pointing it out. Hossam, yeah, I hope so. Nilesh, view on gold ETFs whilst the volatility is on. Nilesh, 5% for the long term. I'm sorry, I can't give you a trade. I don't want you to trade. Okay, so that's me. That's it. Have we got a couple more? We've got quite a large size of numbers. You spoke earlier about a correction this year. Yeah, 13%, 14%. And buying the app buying opportunities may present. So how much cash-wise would you hold back to fund this? None at the moment. I've got 90% in the stock market. So, the fact that this thing about people saying, oh, well, I'm just holding some cash in case it dips. I'm like, okay, good luck with that strategy. Have you tested it historically? Has it worked out? It seems a bit of a gamble. Okay, there might not be a correction. I'm invested in. So we want negative growth. Well, sure, if you could actually get the example I gave you perfect negative, then that would be fine, but you're not. That's not going to happen. Okay. What you actually want is things which are as uncorrelated as possible to each other. Okay. Because the perfect non-correlation amongst each other isn't going to happen. The lack of correlation has been shown by Nobel Prize winner Sharp and Markowitz to create longer term wealth, because timing doesn't work. Eugene Fehmer, Nobel Prize. Okay, timing doesn't work is Eugene Fehmer's Nobel Prize, and Markowitz's Nobel Prize is non-correlation. Whereas what people thought was find inversely correlated assets and time the market. And these people won the Nobel Prize for showing that was the exact opposite of what you should be doing. Hopefully that makes sense. Yes, close to zero correlation if you can get it. But don't forget, in falling markets, correlation increases. So you'll never get persistent non-correlation. It doesn't exist. When the markets fall, everything falls simultaneously. But if in quieter times it's uncorrelated, chances are it's going to be a more resilient portfolio going forward. But correlation is just one factor. Undervalued, high growth. No point having something with zero correlation if it's, my bottle of water is zero correlated to Microsoft stock. It ain't going to help your portfolio, is it? So it's got to be undervalued, high growth, dividend yielding. Mm-hmm. Everyone, that's a ton of material. Let me know if you liked the way in which I did it with all the slides and the infograms and everything else, and the fact that I'm afraid it was short notice. It was at 3:00, but we had a lot of people on, so that's good. So if there's any other issues, let me know. And what I would say is actually, if you got a campaign for $1 million, and you look at campaignfor1million.com/tools, you will see this. And these slides will go up on the blog over the next couple of days or so as well. So campaignfor1million.com tools, and you'll find phenomenal tools which will allow you to see. I'm going to show you something which is incredible and it'll blow your mind. And they're all free. Don't even have to give your email address, which will show you, for instance, a portfolio stress test. So you can stress test if your portfolio is 100,000. Okay, what would happen based on how much could you withdraw, good and bad years, and so on. But it gets better. We have also got safe withdrawal rate calculators, rate your pension age, lifestyle calculator, all sorts of calculators on there, and they're all completely free as well. Okay, so that's campaignfor1million.com. Thank you all very much. I'm going to go. Please, I know there was a ton of information. Hope not too much. Thank you all so much. And if you've got further questions, my email address is on campaignfor1million.com as well. Thanks, everyone. Thanks for watching. Really appreciate it. Try to keep it under an hour. I didn't quite manage. It's gone over by 10 minutes, but hopefully more interesting than Donald Trump's talk at Davos. Thank you.